Welcome back. You're watching The Money Show on ET now. Well, we've been telling you that in just a short while, we'll be talking to one of the best performing small cap fund managers and, which is the fund as well that has actually delivered that more than 100% return in the last 1 year, which has actually broken the return and the performance of many large cap blue chip companies as well. So it's the Kotak Small Cap Fund, which predominantly, like the name suggests, invests in small cap companies. On your screen is, some of the stocks, the major ones, of course, that are in the fund in terms of weightage. And look at the return as well, especially in the last 1 year. Morningstar says the return has been more than 130%. So let's welcome on the show now Pankaj Tibrewal, the Senior VP and Fund Manager for Equities with Kotak Mutual Fund. Mr. Tibrewal, it's a pleasure having you with us today on The Money Show. Thank you so much for taking out time. And what a performance, really. I'm sure your unit holders are very pleased. 130% return in the last 1 year. You've beaten many large caps as well. So if I have to ask you, what's the secret sauce, the investment strategy that has aided this?
Thanks, Mobina, for having me on the show and taking that effort to feature the fund. Staying core to our philosophy and staying core to our investing template has been one of the key reasons for the fund to perform. And it's very important for your viewers and any investor who is invested in this fund to understand the investment template which we follow while selecting a stock in this fund. First, on the business side, I think it's very important that we select the right businesses. And our effort is to make sure that we select the companies which have very strong competitive edge, high barriers to entry, and which can sustainably earn higher rate of return on capital invested, which should be higher than the cost of capital over sustainable periods of time, and make sure that they are able to reinvest the cash flows back into the business at higher rates of return. The second important thing is that companies should have a clean accounting structure and a good corporate governance. The third most important is the management, because we acknowledge that we are not going to run this company. It's the promoter and the management team which is the most important, and they are going to run the daily operations. So it's very important that they are passionate about the business, have high levels of integrity, and they are futuristic. And also, what we also kind of look into is that there's a very high evidence of prudent capital allocation in the stocks we select. So these are the few, things which we look into. And last but not the least, obviously, the price which we are buying it, which is valuation, which we make sure that there's enough margin of safety. Because the first rule which we follow is don't lose money. And rule number 2 is follow rule number 1. So the most important part is that don't look at upside, but make sure that the company doesn't lose money over the medium to long term. And once we do that, we have seen that we have found multi-baggers and compounders in our portfolio. So these are some of the basic investing principles which we have followed and stayed core to them. And that has helped us minimize mistake and crush the risk which this large universe offers, and make sure that we selected the right companies and businesses.
All right. Understood. So, Mr. Tibrewal, what is the future looking like now? Because, of course, as investors, and especially for retail investors, the easiest guide as to how to pick a mutual fund is to look at which one's done the best in the past. So what would you like to tell potential unit holders on, and even, of course, your current unit holders on expected performance going forward?
So, you are right, Rubina, that most of the investors kind of a rear view mirror, and they look at the near-term past performance and try to make sure that they have that kind of a rear view mirror along with them. Can you hear me?
Yes. Go ahead, Mr. Tibrewal.
People have a rear view mirror. So what I would suggest is that don't look at the last 1 year performance. But whenever you are evaluating any fund in any category, it's very important to look at the consistency of the fund. And for that, you have to look at not point-to-point return, but look at the rolling return of the fund over the 3 and a 5-year and a 10-year period. That will throw up a lot of interesting facts, whether the fund has been doing well in a very short period of time, or whether the philosophy is consistent, and that has led to the returns being more predictable and consistent over longer periods of time. And I think that itself is possible when you look at the rolling returns. The second most important point is to look at the drawdown and the standard deviation. It's very important to look at the drawdown ratio, because during phases of correction in the market and cycles have become shorter, it is very important, and it's our endeavor also, that the fund should have lower drawdowns and we protect the capital during correction phase. So that the drawdown ratio will help you understand that what is the drawdown of the fund over a period of time. And the third most important part is to look at the platform where the fund is coming from, whether the fund manager has been long enough in the organization, what kind of a research team is there, what kind of a positioning of the fund is there over longer periods. So I think these few checks one needs to do rather than just getting carried away by the near-term performance.
Okay, understood. Now, the question is that small cap funds do tend to have their own share of volatility. We saw that for a long time, small caps in general were not performing as well as large caps. So how would you like to address that concern that viewers have? And also, more importantly, how do you, I know you mentioned this in your first answer, right, about the quality of companies. So how do you ensure that you don't deviate from that?
A very interesting question, Robina. And if you look at the key objective of our fund is to own a portfolio of 40 to 50 sector-leading franchise with a strong track record of capital allocation, clean accounts, and corporate governance, and at the same time having a high growth potential. In this space, it's very important to know that there's a very high probability of making mistake, because virtually if you remove the first top 100 companies, the entire universe is your area to select the companies from, which is the mid and small cap space. And it's very likely that if you don't follow a process, you can make big mistakes. Whatever process we have kind of inculcated at Kotak over the last decade or so, it's making sure that we make less mistakes by staying away from dubious companies, by staying away from companies which have subpar accounting, subpar corporate governance, and whatever high growth potential even if the company may offer, but if it doesn't tick our boxes in terms of corporate governance, accounting, and some of the other filters which we spoke about, we kind of stay away from those companies. And that has helped us making sure that we minimize our mistakes and risk. However, viewers should know that this category in the short term to medium term can be very volatile. We have seen the period of 2018, from January 2018 till March 2020, the segment saw a huge drawdown and had a huge underperformance versus large caps. And you saw the Nifty index doing extremely well, but Nifty small cap and BSE small cap index actually underperforming massively. So there will be periods of high underperformance, but if you take a slightly longer period of time, say 5 to 10 years, this category tends to be and small cap funds and mid cap funds tend to generate higher returns than large cap. But investors need to be aware there will be bouts of volatility. The volatility of small cap funds will be higher than the large cap funds. And if they have the stomach to digest, this should form part of their asset allocation. But clearly, you are right that in the near term, there could be underperformance of the category and the funds in this small and mid cap space. But if you take a slightly longer term view, this space tends to be rewarding, because every large cap, every mega cap was at some point of time a small cap and a mid cap. So Rome was not built in a day, and so are the companies. Every company starts with small, move into mid, move into large, and then move into mega. So our effort is to try and spot them early in their transition.
Well, actually, that was going to be, my next question as well. That, how do you see this space of mid cap and small cap stocks really move in the near to medium term? Yes, maybe in the next few 1-2 months you may see a bit of a correction, but this is the one category that you have to hold for the long term. So when it comes to time horizon, you have to ensure that you have a long term time horizon in your mind of more than 5 years, 7 years, 10 years. The longer the better, because these small caps will become mid caps and large caps. That's been the case for all the current existing large caps. They were once mid caps. So I think this is something that everyone should sort of take note of. Okay, one last question before I let you go then, Mr. Tibrewal, and that's with respect to how you, how do you sort of, or rather just let's wrap it up with what is the message you'd like to give your unit holders as well, because when we saw that downturn come by in mid and small caps, it lasted for 2016, 17, 18, 19, 20, and finally in the middle of 2020, we started seeing a bit of a resumption. So, for those individuals who are perhaps nearing their retirement or whatever goal it is for which they invested in the fund, do you think that, what would you advise them as well to do?
So the one clear advice which I would like to give all the investors and unit holders or potential investors is that don't just look at the near-term return and chase performance. Generally, that's the tendency. But if you are investing today, make sure you at least have a 3 to 5 year investing horizon in mind. If anything less than that, probably this category is not made for you. Second, you should be aware that this category has higher volatility. So there will be periods where you could see sharp drawdowns. But if you are able to digest that drawdown and you think that your risk appetite is good enough for that, probably you should have allocation to this category. The third is follow your disciplined asset allocation approach. This should not be just one portion of your entire fund allocation. It should be a part of that. Obviously, you would have large caps, you would have multi-cap, flexi-caps, and mid and small caps. And depending on the risk appetite and depending on what your financial consultant believes in, you should have allocation to this space. Last but not the least, always try to do more research on the parameters which I spoke about, along with your financial advisors, what's the drawdown ratio of this fund, what's the Sharpe ratio, standard deviation, what is the rolling return over a 3, 5, 7 year period for this fund, which will reveal a lot of facts, and make sure that you are consistent with your thought process and allocation. So these are some of the messages which probably investors need to carry in mind and not get carried away by just 1 year return, and make sure that their allocation is more from a medium to long term perspective.
Okay. All right. Well, I think that's everything we need to understand about the small cap fund, the style of investing, adopted by Kotak Small Cap, and what unit holders as well can expect. Thank you so much, Mr. Tibrewal, for joining us today on the show.
Thank you. It's my pleasure.